Good morning. Let's talk about the European Central Bank, or ECB, the main financial guardian for countries using the euro. Its top job? Keeping prices stable so your money holds its value. The ECB manages this by adjusting interest rates, which affects everything from your mortgage to your savings. When rates change, it ripples through the economy, impacting loans, jobs, and even the price of imported goods. Every few weeks, ECB leaders meet in Frankfurt to review economic data and decide whether to raise, lower, or hold rates. Their decisions directly shape your financial world, from monthly payments to job opportunities. The latest meeting in October 2025 was a key moment, signaling where the Eurozone economy might head next. Understanding the ECB is the first step to understanding your own financial future. To understand why the ECB's latest move is so significant, let's take a step back and trace the journey that brought us here. The story of interest rates is one of constant adaptation, shaped by the challenges and shocks facing Europe's economy. In 2024, the European Central Bank made headlines by raising interest rates to a record 4%. This bold step was a direct response to runaway inflation, which was hitting households hard, especially when it came to essentials like energy and food. Prices were climbing at the fastest pace in decades, and the ECB needed to act decisively. These high rates did help to cool off spending and gradually slow inflation, but they came with a cost. Businesses faced higher borrowing expenses, and consumers started to cut back, leading to slower economic growth. Some sectors even saw layoffs and closures, raising concerns about a possible recession. As inflation pressures finally began to ease, the ECB changed course. In June 2025, it cut rates down to 2%, signaling a new phase. This move was designed to give the economy some breathing room and encourage investment and spending again. The rate cut was a clear message. The worst of the inflation crisis was likely behind us, and it was time to support a fragile recovery. Businesses and investors responded with cautious optimism, hoping for a return to steady growth. Since then, the ECB has chosen to keep rates steady, carefully monitoring the situation. This wait-and-see approach reflects the uncertainty that still lingers in the global economy. The central bank's main goal now is to watch how the economy reacts to these changes and make sure inflation doesn't flare up again. Every new data point is scrutinized for signs of trouble or progress. It's a delicate balancing act, supporting growth while keeping inflation in check. The decisions made now will shape Europe's economic future, especially as the October meeting approaches. The ECB's journey from aggressive rate hikes to a more cautious, stable stance highlights how central banks must adapt to shifting economic winds. Each move is a response to new realities and risks. Now, the focus is on maintaining stability and confidence, ensuring that inflation remains under control, while giving the economy the space it needs to grow. At the October 30th meeting, the ECB kept its key interest rate at 2%. This marks the third straight meeting with no change, a clear signal of caution. By holding steady, the ECB believes rates are just right, not too high to hurt growth, not too low to fuel inflation. Think of it as finding a comfortable cruising speed for the economy. The ECB is taking a data-driven, meeting-by-meeting approach, ready to adjust if needed. This flexibility is crucial in uncertain times. The pause also suggests the ECB feels it's done enough for now, waiting to see how the economy responds. The key takeaway: patience and vigilance as the ECB monitors inflation and growth. The next move will depend entirely on how the data unfolds. Inflation is at the heart of the ECB's decision. Every move the European Central Bank makes is shaped by its mission to keep prices stable, ensuring that the value of the euro remains reliable for millions across the continent. The latest data shows Eurozone inflation at 2.2%, just above the target, but much improved from recent highs. Not long ago, inflation soared to levels not seen in decades, squeezing household budgets and challenging businesses. Energy prices have stabilized, and supply chain issues have eased, allowing the ECB to step back from aggressive rate hikes. The global shocks that once drove costs higher are now less severe, giving policymakers some breathing room. Still, the ECB is cautious. Even as pressures ease, the risk of inflation flaring up again remains ever present. Rising wages could push prices up again if not managed carefully. As workers seek higher pay to keep up with living costs, businesses may pass those costs on to consumers, fueling a new round of price increases. The challenge: support rising incomes without triggering another inflation surge. Policymakers must weigh the needs of families and businesses against the risk of letting inflation spiral out of control. Holding rates at 2% aims to keep inflation near target without stifling recovery. It's a careful compromise, designed to encourage growth while keeping a lid on price increases. Cutting rates further could overheat the economy. Raising them could stall growth. The ECB must constantly assess the risks on both sides, knowing that even small changes can have big consequences. For now, the ECB is watching closely, ready to act if inflation strays from the sweet spot. Every new data point is scrutinized, and every trend is analyzed for signs of trouble ahead. It's a delicate balance, one that requires constant vigilance. The ECB's job is like walking a tightrope, where a single misstep could tip the economy off course. The ECB's steady hand is meant to keep both inflation and growth on track. By communicating clearly and acting decisively, the bank aims to build confidence among investors, businesses, and the public. The plan: stay put, monitor, and adjust, only if the data demands it. In this uncertain environment, patience and flexibility are the ECB's greatest tools. Economic growth is the other side of the coin. The Eurozone grew by 0.2% in Q3 2025. Modest, but better than expected. The services sector, tourism, restaurants, digital services, is thriving, boosted by strong consumer spending. Manufacturing, however, is struggling with trade tensions, uncertainty, and a strong euro making exports pricier. This split creates a challenge: how to support both sectors moving at different speeds. The ECB's steady rate is a compromise, helping services without further hurting manufacturing. A rate cut could overheat services. A hike could worsen manufacturing woes. The current 2% rate aims to balance these competing forces. Policymakers must navigate this uneven recovery carefully. The ECB's decision reflects the complexity of Europe's economic landscape. After the decision, ECB President Christine Lagarde offered insight into the bank's thinking. She highlighted strong consumer spending as a key driver, with real incomes rising as inflation cools. Lagarde is cautiously optimistic. Stable prices mean households can spend more, supporting the services sector. But she's realistic about manufacturing's ongoing struggles due to global trade issues. The ECB isn't expecting a quick turnaround for factories. Importantly, Lagarde signaled that the rate-cutting cycle is likely ending. Other ECB officials echoed this, suggesting 2% could be the new normal for some time. The message to markets: don't expect more cuts soon. The ECB will stick to its meeting-by-meeting approach, adjusting only if the data shifts. For now, stability is the priority. What does a steady 2% rate mean for you? Loan rates, like mortgages and car loans, are likely to stay stable, so borrowing costs won't spike or drop suddenly. Savers can expect modest, predictable returns. No big jumps, but no return to near-zero rates either. The ECB's goal is a Goldilocks economy: steady growth, stable prices, and a healthy job market. By holding rates, the ECB supports hiring and investment while keeping inflation in check. Your paycheck should go further, and prices at the supermarket should remain stable. The euro's value dipped slightly after the announcement, making imports a bit pricier, but helping European exports. This could support jobs in manufacturing and export sectors. Overall, expect a period of stability in borrowing, saving, and prices. The ECB's steady hand is designed to keep your financial life predictable. After the ECB's announcement, the euro slipped against the US dollar. This immediate reaction in the currency markets reflected how sensitive investors are to even subtle shifts in central bank policy. The euro's decline signaled that traders were recalibrating their expectations for Europe's economic prospects, especially compared to the US, where growth and interest rates have remained relatively robust. Investors saw the ECB's cautious tone as a sign that Europe's growth may lag behind the US. The mood in financial markets turned more anxious, with many questioning whether the Eurozone can keep pace with global competitors. Some investors even began to shift their assets to what they saw as safer or more promising markets. But currency moves are just one part of a bigger story. The euro's value is influenced by a web of factors, from trade balances to geopolitical risks, and it often acts as a barometer for the continent's overall health. Europe faces three major challenges: higher energy costs after losing cheap Russian supplies, tougher global trade conditions, and increased defense spending. Each of these issues puts unique pressure on the economy, making recovery more complicated. These triple shocks are reshaping the continent's economy. Energy transitions are costly, trade tensions hurt exports, and the need to invest in security is diverting resources from other priorities like innovation and infrastructure. More money is going to defense instead of growth, forcing governments to make tough choices about where to allocate limited funds. This shift could have long-term consequences for Europe's competitiveness and living standards. The ECB's monetary policy can't solve these structural issues alone. While interest rates and financial tools can help manage inflation and support stability, they can't address the root causes of Europe's current challenges. Policymakers must adapt to this new reality, balancing short-term stability with long-term change. This means working together across governments, industries, and institutions to find creative solutions. The euro's reaction reflects investor uncertainty about Europe's future growth. It's a reminder that confidence can shift quickly, and that economic resilience depends on more than just central bank decisions. The ECB's job is to steer through these challenges with careful, flexible policy. But it will take coordinated action and forward-thinking leadership to secure Europe's place in a changing world. Monetary policy is just one piece of Europe's complex economic puzzle. The path forward will require resilience, adaptability, and a willingness to confront new realities head-on. What's next? Most economists expect the ECB to keep rates at 2% through 2025 and likely into 2026. The era of dramatic rate changes appears over for now. Experts see a new phase: slower growth, stable inflation, and steady rates. The ECB's message is clear: decisions will be data-driven and flexible. If inflation or growth shifts unexpectedly, the ECB is ready to act. For now, the plan is to hold steady and support a modest recovery. After years of turbulence, stability in prices and borrowing costs is welcome news. The ECB's careful approach aims to keep the Eurozone on a steady course.